Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Earnings season is now all done, and overall it was probably a bit on the disappointing side, maybe a bit soft. There were some standout performances, of course, but overall it seemed like labour shortages and high costs are hitting a lot of companies quite hard. I wanted to talk to Roger Montgomery for his take on the winners and losers and what investors should be thinking about now that it's all done. Remember, this is general information only. You should get professional advice before making any investment decisions. Roger Montgomery is the founder and chief investment officer of Montgomery Investment Management. Roger, welcome back to Fear and Greed.
Good to be with you, gents.
So, what are the key themes out of earnings season?
Well, I think it was all well flagged. There weren't a huge number of enormous surprises. So about just slightly less than a third of companies came in line or reported in line with expectations. A little bit more, slightly more than 40% beat expectations, and the remainder disappointed. I really do think, though, that the overwhelming influence on stock prices from the results will actually come through in September rather than immediately after the results. And that's because it really is some days are becoming quite overwhelming for analysts to actually process. On a busy day, you'll have more than 110 companies reporting, and there's absolutely no way that you can analyse the results in sufficient detail to be able to make a wise investment decision on 110 different stocks. And so, I think it'll be this post-reporting period where analysts and portfolio managers have the opportunity to meet with companies or with brokers and analysts that are covering those companies, and they'll be able to make wiser decisions about whether or not those particular companies deserve a place in portfolios. And the other reason why I'll just say it this way, I think that is perhaps more relevant at the moment for investors what's happening on a macro level, which seems to be overwhelming what's happening on an individual company level at the moment.
And that's very much the outlook for interest rates and inflation and potential recession, what's happening in China, that sort of thing.
Indeed. And perhaps something that I don't hear a lot of, there's an enormous amount of talk about interest rates. There's far less talk about what's happening in global liquidity and what central banks are doing with their balance sheets. And interestingly, the correlation is very high between stock market moves at the moment on a weekly and monthly basis and what central banks in aggregate are doing in terms of their balance sheets. So, from January through to June, there was a significant reduction in global liquidity as a result of banks or quantitative tapering, if you like. Yep, and then, of course, in July, well, not of course, but in July, the banks, I think, blinked and paused on the shrinking of their balance sheets. And the consequence of that, of course, was the very significant rally that we saw in stock prices. So I think those sorts of things are perhaps overwhelming what's going on this reporting season. In the absence of those, we might have seen some more determined or more consistent moves that reflected the results.
Okay. So given that macroeconomic overview, if we look at what some of those companies have said and what it's kind of the next 12 months or so the macro variables do still dominate, but over time, kind of individual stocks will obviously outperform and not.
Oh, indeed. And that is absolutely correct. And that's why that provides a great opportunity.
Yeah, okay. So, pricing power, that seemed to be a big thing. Companies who have pricing power are in a much better position, it seems.
Yeah, definitely. Let's take the example of Coles. Coles demonstrated, aside from the fact they're losing share to Woolworths, they demonstrated they weren't able to leverage food inflation. And that's surprising, I think. I think those stalwart type businesses, Woolies and Coles and Wesfarmers, there's an expectation built into their share prices and the investment thesis that they can leverage food inflation, pass it on to the consumer. But what we're seeing is the consumer's share of wallet is shrinking, that it has discretionary. And so consumers are trading down even in food. So where they might have bought a steak, they're buying mince. And if inflation continues to be worse, where they might have bought beef mince, they'll switch to chicken or pork and go for cheaper meats, even within the cheaper categories of mince. And so we're seeing a lot of that movement. The other thing in terms of inflation that I think is important to remember is that the CEOs of these companies are listening to the Fear and Greed podcast. They're reading articles that I write in the Australian. They're mouthing that stuff back to the investor. Yeah, so there's a loop that goes on here. So it's really difficult to discern what's actually not being influenced by the stuff we're writing and saying.
Stay with me, Roger. We'll be back in a minute. My guest this morning is Roger Montgomery, founder and chief investment officer of Montgomery Investment Management. What about those who really do have pricing power? And I mean, I suppose the coal companies are the biggest example of that. How long does that last?
Well, firstly, you got to remember there are discretionary items and there are non-discretionary, and presumably heating your home and powering the lights is non-discretionary.
Yep.
So there is a lot more pricing power there. When you think about pricing power, you think about elasticity of demand. How flexible are consumers in terms of the choices that they have and can make when prices go up, or they don't like the price that's being charged. And when it comes to coal, which is the example that you've given, there's probably not many alternatives. The alternatives that exist are fundamentally at the moment more expensive. They're coming down, of course. Green energy is coming down and it will continue to do so. But at the moment, it's still an expensive alternative for most people. So coal's probably not a good example of the businesses that might suffer if prices are raised.
Yep. Okay. I want to ask you about retailers. So we talked about the Woolworths, Coles, Wes, but the discretionary retailers and the online retailers, particularly online retailers, some of them didn't look real good at the end of this earnings season.
No, that's right. There were some good ones. So Kogan, for example, was a business that wasn't great, but then you had Lovisa, which just shot the lights out, and I think the market was really, really excited about that business and its ability to continue to grow. It's going for world domination. Don't forget that, and it's got great people at the helm who are running it. And then, of course, you've got a business like Kogan, which suffered from, I think, the cost of its products increasing. But more importantly, I think it suffered from not only that shrinking share of wallet that's available for discretionary spending, but also a switch that's occurring from spending on goods to spending on services. I call it the economics of enough. I've been doing this now for 33 years, and I've seen it several times where you get a big surge of spending. And I remember in the late 1990s, the big item that people spent money on, they borrowed against their house, or they redrew on their mortgages to buy BMW X5s. And that was something that I wrote about at the time. Everyone needed a BMW X5. But then what happens after that surge, after that big spike in spending, you get a period of indigestion. And I call it the economics of enough. It's when people have just decided, I've bought enough stuff and I just don't need to buy any more. And I think Kogan is a victim of that. During the pandemic, in lockdown, people were spending money. They weren't working from home as people thought they were. They were actually surfing the internet, buying stuff that was being delivered to their door, drinking and gambling, and maybe doing a bit of work as well, but not as much as the other things, according to all the stats that I saw and all the companies I spoke to. And so now that's shifting, and there's probably going to be a relatively greater shift towards spending on services, and by that I mean entertainment, dinners, going out, that sort of thing. And so discretionary retailers are also suffering from that. And for some of them, it's going to be a particularly difficult Christmas because they've also built up their inventory. And that surprised analysts as well, that, in many cases, inventory had been built up in anticipation of a really strong spending event towards Christmas. But we may find, and I don't know who's going to be the worst at this, but we may find that there's a lot of discounting that goes on between now and Christmas as a consequence of that build-up in inventory for retailers in the discretionary spending space.
Okay, so just wrapping this up a bit, what should investors be thinking about for the next 6 to 12 months? So retail investors out there, what should they be keeping an eye on to understand better where they should be putting their money?
So I think what investors should be focused on is quality and growth, and looking for businesses, particularly in the more volatile small cap space. There are businesses there that are growing structurally. Their growth is not beholden to the economic cycle. It's not being influenced by inflation. And where structural growth is, for example, cloud computing and telecommunications, where structural growth is occurring, there's going to be continued growth. At the moment, investors are very nervous about growth companies because the PEs have been, for quite some time, the PEs have been elevated. But as those PEs compress, you're more certain of a great return if you buy a business with strong and sustainable EPS growth. In the slightly larger, the mid cap to large cap space, you take a business like REA Group. Every year, there are young analysts that turn up that are new to the job, and they believe that REA's revenues and EBITDA are linked to house prices. So when house prices come down, they think that REA is going to suffer, when in actual fact, REA, its revenues are linked to the number of listings and its ability to raise prices, which it has been able to do almost annually for the last decade. So there's a business that has grown its revenue, its EBITDA, its NPAT by 23 to 25% per annum for the last 12 years or so, or even 15 years. And despite that, because people think property prices are going to fall, and that may in fact happen, and indeed it already is happening, but its share price went from $180 down to $93.77, then back up to $130 odd. So that's the sort of business that if we get another leg down in the stock market, which is possible if central banks continue to taper their quantitative monetary policy, if they continue to do that, and their balance sheets shrink, and we find liquidity starts to tighten, then what we might find is globally, a wave of credit ratings downgrades and contracting liquidity that could bring the stock market down. If that does happen, and I don't know if it will, but if it does happen, that should be seen as an opportunity rather than a risk. And the opportunity is to buy those really high quality businesses, REA, for example, in the mid cap or large cap space, Symbio in the small cap space, businesses like Macquarie Telecom, for example, those structural growth businesses. If share prices come off for those businesses, it's an opportunity to take advantage of them and put them in your portfolio.
Roger, thank you for talking to Fear and Greed.
A pleasure.
That was Roger Montgomery, founder and chief investment officer of Montgomery Investment Management. This is a Fear and Greed daily interview. Remember, this information is general in nature and you should seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.